Everyone told you not to worry about your student loan. It's not like normal debt, just let it run. And for millions of UK graduates, that advice is completely correct. But for a specific group, probably more of you than you think, that exact advice is causing you to miss a window where overpaying would save tens of thousands of pounds in interest. And at the same time, there are people who are overpaying their student loan when the government was going to wipe it out for free anyway, effectively donating money to the Treasury. Both groups exist. Both are making expensive mistakes. Today, we're going to put you in the right category, with actual numbers, and tell you exactly what to do. Before we get into the numbers, we need to establish one thing clearly. A UK student loan is not a debt in the way your mortgage or credit card is a debt. There are no bailiffs. It doesn't appear on your credit file. You never have to make a payment unless you're earning above the threshold. And crucially, it gets written off entirely after a set period, whether you've repaid it in full or not. The remaining balance simply disappears. What it actually is, functionally, is a graduate income tax. You pay 9% of everything you earn above your threshold, not 9% of your balance, not based on what you borrowed, just 9% of income above the line. Stop earning above the threshold, the repayments stop automatically. That distinction matters enormously because it completely changes the question from how do I pay this off to will I ever pay this off at all? And the answer to that second question determines everything else in this video. There are now 5 student loan plans in the UK, plus the postgraduate loan, and the rules are meaningfully different between them. Let me walk through each one. Plan 1 covers anyone who started before September 2012 or in Scotland and Northern Ireland. The threshold for 2026-27 is £26,900. Interest is set at RPI or the Bank of England base rate plus 1%, whichever is lower, making it the cheapest rate of any plan. Write-off is 25 years from the April you first became liable to repay or when you reach age 65. Plan 2 is the most common plan. Anyone who started an undergraduate course in England or Wales between 2012 and 2023. Threshold this year, £29,385, up from its multi-year freeze after a government announcement. Interest scales from RPI at the threshold up to RPI plus 3% for those earning above £52,885, capped at 6% for 2026-27. Write-off after 30 years. Plan 4 is for Scottish students who started post-2012. The threshold is £33,795, the highest of any plan. 30-year write-off. Plan 5 is new, for students starting from August 2023 in England. Threshold is £25,000, frozen with no inflation link until at least 2027. Interest rate is RPI only, no top-up. But the write-off period is 40 years, the longest of any plan. Postgraduate loan, threshold £21,000, frozen since 2016, 6% repayment rate. If you hold both an undergraduate and a postgraduate loan, both deduct simultaneously, taking up to 15% of income above respective thresholds combined. Write-off after 30 years.
Here's something most graduates have never calculated. What is your actual marginal rate? The percentage you lose on every additional pound you earn. If you're on Plan 2 and earning £35,000 in 2026-27, you're paying 20% income tax, 8% national insurance, and 9% student loan repayment on every pound above the threshold. That gives you a combined marginal rate of 37%. For every extra pound you earn above the threshold, you keep just 63 pence. If you're a higher rate taxpayer on Plan 2, earning above £50,270, your marginal rate becomes 40% tax, 2% national insurance above the upper earnings limit, and 9% student loan. That's 51% combined. You keep 49 pence in every pound. And if you also have a postgraduate loan, add another 6% on top. We're now talking about a 57% combined marginal rate. More than half of every pound you earn above both thresholds goes somewhere other than your pocket. Most people don't know this. Their employer doesn't tell them. Their payslip just shows a deduction labeled student loan. Understanding this marginal rate is the first reason why, for many people, redirecting extra money into a pension via salary sacrifice, where you get 20 to 40% tax relief, makes far more financial sense than accelerating your student loan repayments. Now we get to the core question: should you overpay your student loan? The honest answer depends on three numbers, and you need all three before you can decide. Number 1, your current outstanding balance. Log into the Student Loans Company portal and get the exact figure. Most Plan 2 graduates left university owing between £40,000 and £60,000. Interest has likely added to that since. Number 2, your realistic salary trajectory. Not your dream salary, your actual likely career path. The IFS estimates that roughly 75% of Plan 2 graduates will never repay their loan in full before the 30-year write-off. If you're on a median salary in a non-specialist field, you're almost certainly in that 75%. Overpaying is giving money to the government that it was going to cancel anyway. Number 3, your write-off date. This is the single most important number, and almost nobody knows it. Take the April after your first repayment was due, typically the April after graduation, and count forward 25 years for Plan 1, 30 years for Plans 2 and 4, or 40 years for Plan 5. That date is when your balance disappears regardless. Now do the maths. At your current balance, your expected salary growth, and the applicable interest rate, will you clear the balance before that write-off date? If yes, overpaying makes sense and could save you meaningful interest. If no, every voluntary overpayment you make is reducing a balance that was going to be wiped for free. Stop. Redirect that money. One of the most common reasons people consider overpaying their student loan is the belief that it's stopping them getting a mortgage. Let's look at what the numbers actually say. Student loans do not appear on your credit file. They are not treated as consumer debt by lenders. Your credit score is not affected by having a student loan balance, even a large one. However, and this matters, student loan repayments do reduce your net take-home pay, and mortgage lenders use your net income when calculating affordability. So your repayments do indirectly reduce how much you can borrow. The practical impact: most lenders reduce maximum borrowing by roughly 3 to 4 times your annual student loan repayment. On Plan 2, at a £35,000 salary, your annual repayment is about £505, meaning your maximum mortgage could be reduced by approximately £1,500 to £2,000. That is not going to be the deciding factor on whether you can buy a house. At higher salaries, say £60,000, annual Plan 2 repayments are around £2,754. That could reduce your mortgage borrowing by up to £11,000. More meaningful, but still not a reason to liquidate savings or redirect pension contributions just to clear the loan. The exception, if you're right on the affordability boundary, where a specific property is at the very edge of what lenders will offer you, and overpaying your student loan for 12 to 18 months would move you above that boundary, then there may be a targeted case for it. But that's a very specific scenario, not a general rule.
If you started university after August 2023 and took out a loan in England, you're on Plan 5. And Plan 5 deserves its own segment because it is meaningfully different from Plan 2 in ways that most people don't realize. The repayment threshold for Plan 5 is currently £25,000, the lowest of any undergraduate plan. It's frozen with no inflation link until at least April 2027. This is fiscal drag in action again. As wages rise with inflation, a larger and larger portion of your income will exceed the threshold, meaning your repayments grow even if your real purchasing power hasn't. The interest rate is better. just RPI with no income-related top-up. That's more predictable and cheaper than Plan 2's sliding scale. But the write-off period is 40 years, a full decade longer than Plan 2. That means Plan 5 borrowers are significantly more likely to repay their full balance before write-off, which changes the overpayment calculation entirely. For Plan 5 borrowers who are high earners, doctors, lawyers, engineers, there is a realistic case that you will clear your balance before the 40-year mark, making the question of overpaying more genuinely worth modeling. Run the 3-number test. The answer may be different than it would be for a Plan 2 borrower in the same role.
Right. You've run the 3-number test. You know whether you're likely to repay your loan before write-off. Now let's talk about what to do with any extra money you have in the right priority order. For the majority of Plan 2 graduates who will not repay before write-off, the correct order is this. First, if you have any high-interest debt, credit cards or personal loans above 6%, clear those first. Student loan interest at 6% or below is not worth prioritizing over 20% credit card debt. Second, maximize your employer pension match. If your employer will match contributions above auto-enrollment minimums, that is a guaranteed 100% return on every extra pound you put in. Nothing else in personal finance competes with that. Third, salary sacrifice pension contributions. At basic rate, every £1 into your pension costs you 80 pence in take-home pay. At higher rate, 60 pence. The student loan repayment you might have made costs you 100 pence per pound. The pension wins. Fourth, ISA contributions, tax-free growth, flexible access, and you're building the bridge fund we discussed in our early retirement video. Fifth, only after all of the above, if you've projected you will clear your loan before write-off, consider targeted overpayments, not before. For Plan 5 high earners specifically, run the calculator first. If your projected clearance date is 10 or more years before your 40-year write-off, there is a mathematical case for strategic overpayment to reduce the total interest paid. But even then, model it against the pension alternative first. Here's what you do this week. 1. Log into your student loans company account at gov.uk. Find your exact balance and your write-off date. Write that date down. It is the most important number in this entire conversation. 2. Identify which plan you are on. If you're not sure, check your original loan agreement or contact the SLC directly. Getting the wrong plan deducted from your pay is more common than you think and worth checking on your next payslip. 3. Run the 3-number test. Balance, salary trajectory, write-off date. If you will not repay before write-off, stop any voluntary overpayments immediately and redirect that money to a pension or ISA. 4. If you're a basic rate taxpayer making voluntary overpayments right now and your loan is more than 10 years from write-off, do the pension calculation. A salary sacrifice pension contribution of the same amount will save you more money with near certainty. 5. Share this video with anyone who is either anxiously overpaying or has never thought about whether they should. The default, just letting the PAYE deductions run and ignoring the whole thing, is usually fine, but knowing why it's fine and knowing when it isn't is worth 30 minutes of your time.